Welcome to Economy Made Simple. I am Shamubeel Eaqub, the Chief Economist at Simplicity. There's a lot going on in the world right now, and I'm here to make sense of it. Brought to you by Simplicity, New Zealand's non-profit KiwiSaver and fund manager, who are on a mission to make Kiwis richer and smarter with money. Today I want to talk about what's happening with the economy. Spring is here, but unfortunately for the economy, the recovery is not yet here. What we're seeing is an economy that's taken almost a double dip. This winter has been really tough, and that pain is stretching into spring. There's a few reasons for that. One is around households are under a lot of pressure from rising cost of living, particularly the necessities, and businesses saying that their sales are falling. Globally, we're seeing lots of uncertainty. It's not really affecting things yet, but there's just fear that's affecting everybody. And finally, in New Zealand, we're also seeing some headwinds. One has been from the government being quite slow to spend, particularly in infrastructure, but it looks like that's going to change in the next little while. The other headwind has been around immigration that has slowed, that's taken a little bit of that momentum out of the economy. But there is good news around the corner. The Reserve Bank has belatedly realized that this recession is deep and long, certainly deeper and longer than the global financial crisis, and they're going to cut interest rates further. But because it takes a while for the benefit to come through, that good news is probably not going to be with us until the beginning of 2026. One of the big things that's affecting the economy is just that fear around the unknown. Around the world, we're seeing politics is being reimagined. What used to be normal is now no longer normal. We're seeing an escalation of war. We're seeing policies that we hadn't thought were going to be normal, like tariffs, but also bigger things like an attack on institutions. For example, almost this independence of the Federal Reserve, the central bank of the US, seems to be under attack at the moment. These are big things, and it's not clear to the markets and market participants and, I guess, people like you and me. What's been surprising is, despite this fear, what we're seeing in financial markets, it's quite divided. Equity markets are still on a roar. Markets have been very healthy over the course of the last year, with the exception of when Liberation Day was announced by Trump, which unfortunately liberated us from our money. But what we have seen is something different that's taking place in other parts of the market. For example, what's happening with the price of money for governments. So the cost of borrowing for the US government has increased, and right now it's very similar to the cost of borrowing for New Zealand, which is really, really unusual. It's very rare that our cost of borrowing is the same as the biggest, richest country in the world. And it's saying that something's going on in the markets that are unusual. And we're seeing the same kind of thing that's happening in one key thing that I look at, which is the price of gold. Gold tends to be that safe haven. When people are fearful, they don't know what to do, where to go, quite often we'll see people parking their funds and their money in gold. Over the last year, we've seen this incredible surge in gold prices. So this increase in interest rates, the increase in gold prices are telling us that there is some fear that's around in the market, but we're not quite sure if that's going to flow through to the real economy, when and how. And this uncertainty is weighing on everybody right now. This fear has been unusual in the way that has translated into the economy. When it comes to the vibes, the confidence of people, it has been quite dark. People are still feeling quite raw on the back of COVID, the cost of living crisis, the recession, both here and internationally. But when we look at what's going on with global trade, that's still growing. Not as fast as it was about a year ago, but it's still growing at a relatively good pace. And this disconnect is really unusual again, where the fear has not yet shown up in the real data. And I think that's what we're seeing in terms of people trying to make sense of the world. We're finding that things are very unusual and different from what we had experienced before. And my kind of interpretation is that we are living in a world that is very different today. And we're not going to be able to use our old rules of thumbs to make sense of the world. And when we can't predict the future, we need to be much more curious and much more humble in the way that we think about things, which probably doesn't give you a lot of confidence about the forecast that you see from economists and the Reserve Bank and others. But the reality is that forecasts have always been uncertain. And right now, they're just more uncertain than they have been before. And that's been the story of New Zealand. Our forecast, where last year the story was, just hang on, next year will be better. And this year we're saying, just hang on, next year will be better. And maybe like the broken clock will be right. But right now what we're seeing in the data is, after a bit of a recovery in the early part of this year from quite negative to slightly positive, things have slowed again, both for consumers and for businesses. We've seen households telling us that My finances are getting worse. And it's not surprising, right? Because the cost of living, particularly things that we see very regularly, cost of food, groceries, electricity, rates, insurance, those have all increased really, really fast in the last 12 months. And businesses are seeing the consequence of that because people are being careful, they're being more careful with the way that they spend, what they spend their money on, and sales in businesses have moderated in the last 3 to 6 months. And so this means that we're in this very kind of weird situation where after this initial burst of a recovery, we're almost in this second kind of dip, and that is what we're experiencing in the economy right now. It's been a really tough cycle. It's been a tough cycle because this recession has kind of been around for the last couple of years. We had pretty strong population growth after COVID to just kind of paper over the weakness. But the reality is that when you look at kind of the average rate of growth for our prosperity, GDP per capita, that's been falling for the last couple of years. And when I compared this recession compared to previous ones, this is one of the deepest and longest, pretty much in living memory. You really have to go back to the economic reforms of the 1980s to see one that was more disruptive and more damaging. This recession is predicted to be, by the Reserve Bank and other banks and economists, to be deeper and longer than the global financial crisis. Even though there is optimism that the recovery will come next year, it is probably going to be shallow. So we just need to be prepared about this economic cycle being quite different from the ones we've experienced before. Part of the reason why New Zealand tends to experience these economic cycles that are deeper, longer, more damaging than other countries, particularly I compare ourselves to Australia, is partly because of our size. Our small scale does mean we get whipped around a bit more, but also because our policies tend to move up and down very rapidly. So there's two examples. One is around immigration. We kind of switch from love and hate about immigration. Either we don't have enough people coming to New Zealand, why doesn't anybody love us? Or we have too many people coming in, and why is everybody coming to New Zealand? As a result, we tend to find immigration has this big boom-bust cycles, and that's affecting the economic cycle, not necessarily a good quality of economic growth, but certainly when immigration slows, it takes the demand away from the overall economy. The other boom-bust that we see is from the central bank. The Reserve Bank of New Zealand tends to be quite aggressive in hiking interest rates. It's really fearful of inflation. But when there is a deep recession, people are losing their jobs, they're far less willing to cut interest rates. And that's what we have seen this cycle as well. The Reserve Bank has finally woken up to the fact that this recession is doing a lot of damage, and they are going to cut interest rates again. And we want to see that because it's important and necessary. To give you an example of why this recession is different and why we've kind of been a little bit duped by the depth of it is the typical things that we look at haven't fallen as much as usual. So one of them has been jobs. So yes, we've seen some job losses over the course of the last year, but nothing like we had seen during the GFC. That had led some people to say, maybe this recession ain't so bad after all. But what we had seen this time is different in that people weren't getting fired, their hours being reduced. So the full-time equivalent effect on people was much more severe. And in fact, the impact on people's budgets was the same, right? We have less income available, and while it might be good when the recovery comes that we have jobs so we can get back into it, the lived reality of the recession is much the same. And it has coincided with a period of very high cost of living, not in everything. So if you think about, for example, the cost of food, that's up about 5% over the last year. And I was looking at the staples that I buy every week, that's up about 15% from last year. So there is this pockets of inflation that we experience very regularly that really affects our ability to kind of spend on other things. And quite often that's what we're experiencing in those very frequent purchases. That's what affects our mood and our willingness to take those big risks or make those big purchasing decisions. And right now, everybody's on that very much tenterhooks, saying it feels a bit tough and I'm going to be careful. I won't make the decision. I won't go out to the restaurant. I won't book that holiday. And that is the general effect of the recession that we're seeing in the economy right now. And therein lies one of the dilemmas for what we're seeing with the central bank. What they're seeing is inflation as it's measured, on average for everybody, is moderating. It's still holding up at a relatively high level, but it's certainly moderated. But the expectations, the feeling that people have is far more intense, far more raw, and far more painful. And that's why the Reserve Bank had been quite slow to cut interest rates. But as it cuts interest rates, it is going to flow through to people, not everyone, about a third of households in New Zealand who have mortgages. They're going to get quite a lot of relief. And we're going to see people having a little bit of extra budget And in time, we'll see them borrowing money and spending money again. But it's not going to affect everybody, and certainly it's not going to lift all boats at the same time. One of the highlights in the last few months has been the rural sector. We'd seen very good prices, particularly for commodities like dairy. We'd also seen some very good growing conditions after last year's pretty tough conditions in some parts of New Zealand with drought. This year is looking really, really good. So part of this positive in New Zealand today is in the rural economy, particularly in our dairy and horticulture sectors. We're seeing some pretty positive stuff coming through. But we haven't seen that optimism and positivity translate into farmers going out and splurging yet. They're actually being cautious like the rest of us. So while it's true that there is this sense of positivity that's coming from the rural sector, that impact in terms of more spending in the local community, more investment, farmers doing more and lifting up their provincial economies is probably not going to take place for a few months yet. And it's not surprising because farmers had also taken on quite a lot of debt in recent years, and they're being very careful to pay it off. So we're in this weird kind of holding period at the moment. And I think, again, that's really what a recession is about, when everybody's being careful and delaying their decisions. One of the things that I look at very closely is job ads. The reason I look at job ads, it's that realization of optimism into action. In every recovery that I've experienced, job ads tend to lead the recovery. We tend to see businesses getting optimistic, then they start placing job ads, they hire more people, and that really kicks off that economic recovery. So far, we haven't seen much of that. We're seeing just hints that job ads are lifting from extremely low levels, but it's not yet at a place where I'd call it in terms of recovery. So this is one of those key indicators I'm keeping a really close eye on. Like I said before, this recession has been so different and so unusual. Typically, we tend to see job ads doing this V-shaped recovery, a big drop and then a bounce back from the bottom. This time around, we've had a big drop and we're going sideways for the last 6 to 9 months. So again, it's this element of uncertainty and difference that invites caution and humility. One of the big headwinds for the economy had been around government austerity. This government was elected on a platform of spending less, and they certainly have done that when it comes to infrastructure. That less spending, that reduced spending in infrastructure has affected parts of the economy, particularly the construction sector. But there is a lot of pressure politically now for the government to kickstart some of that spending and some of that investment. So I'm pretty confident that by Christmas we're going to see lots of new contracts being written by government, something that hadn't been done over the course of the last year. And that will hopefully give us a little bit more of the catalyst for a recovery in the next little while. And we've got local government elections that have just taken place. That means we're going to get new councillors, new mayors, and there's going to be renewed energy from local government as well to do things differently. Although I do think local government will find it very difficult to do a lot because they've already raised rates so much. There is a lot of discontent in community, and most local governments are carrying too much debt that they do not have the headroom to be able to do much. So we're in this very kind of strange situation where not all cylinders of the economy are firing at the same time. So as we head into spring, this economic recovery does feel very grumpy. It's very much been the case that we had some green shoots of a recovery earlier in the year, and they've petered out through the winter months. It means we're going to be facing a fairly tough kind of end to this year. A lot of that has been to do with just this uncertainty that's prevailing in the global economy. It's not just war, it's also politics, it's also how politics is done. This attack on institutions around the world, including the independence of the central bank in the US, these are very unknown things for all of us to navigate. Keep a close eye on what markets are doing, because what's happening with the price of gold, what's happening with the cost of borrowing for the US government will be strong signals of how markets interpret these risks. When it comes to New Zealand, it's been very much a case of we've had policies that have worsened this cycle. Net migration has slowed very sharply. We've had interest rates that have been too slow to come down, and we've had a government that has reduced spending in the middle of a recession. But all of those things are gradually starting to turn. We know that the Reserve Bank has finally woken up to the fact that this recession is deeper and longer than the global financial crisis, and they'll be cutting interest rates more. The government is woken up to the fact that its deep cuts has been very unpopular amongst business and the public, and it is looking to increase spending in coming months. And there is every sign that some of those big inflationary pressures that have been building over the course of the last few years are easing, even though many of the necessities that we rely on remain expensive. We're in a very funny situation where this recovery has been a long time promised and has failed to materialize. But I feel optimistic that as we start to see some of these positives next year will look a little bit better. But we need to be really mindful that there are still a lot of big risks out there that we simply do not know how to navigate. Take care when you're thinking about these risks, but don't be paralyzed by these risks. It's important to understand and then ask yourself very quickly, what will I do? How can I do things differently that will give me some control back over my life? Thank you for joining me today. If you enjoyed this podcast, please like, share, subscribe, and we'll see you next time. Everything we cover in this session is for general information only. We are not tailoring our comments to your financial situation or providing financial advice or recommendations. This information and comments we provide are not intended to convey any guarantees as to the future performance of any investment products, asset classes, or capital markets. Past performance is no guarantee of future performance. Please refer to our full disclosure statement in the description.